Welcome to the B.F. Anderson Technical Report for April the 14th. Pessimism never won any battle. We talk a lot about human behavior, and basically, pessimism is very prevalent right now. We're seeing where, over 75% of those surveyed are negative on the future of the market for the next 6 months. It works out this way. You're going to find your biggest opportunities when the markets are difficult. This is a difficult market, but usually difficult markets are followed by easy markets, and easy markets are followed by difficult markets. But, fear or pessimism is really a very counterproductive emotion. But even worse is greed, because people generally do things they normally wouldn't do when they're getting too greedy, such as Ponzi schemes. I did want to point out that it does look like the market is somewhat discounting an economic slowdown. The business cycle is as sure as the sun rises, we're going to have a recession. And so basically what tends to happen is that the market will start to discount a recession and go into a bear phase or a negative phase or a difficult phase. But then when you finally get to this point, the market starts to discount recovery. So the question is, can you predict this? And very difficult to do. Now let's just kind of look at the indexes. We've got the NASDAQ continuing to struggle in here. Here's the low that was made back in March. We had our first low pretty much in January, February, and then we're continuing to kind of flounder around in this area. So the NASDAQ on the 35-week moving average, you can see the 35-week continues to stay in a downtrend. We're not getting above it, so we continue to stay cautious on the NASDAQ. Mid-cap stock, same story, pretty much still trying to form that bottom in here. And remember, a bottom is a process. It's not a point in time. New York Composite, all the stocks on the New York Stock Exchange, actually kind of holding up a little bit, holding above that 50-day moving average, but below the 200-day moving average. Small caps continue to struggle. You can see here just basically sideways, trying to form that bottom. S&P 500, we're seeing again, they did not hold the 200-day, somewhat of a failed breakout, barely holding the 50-day. So we would continue to be very selective in here. We're finding stocks to be very difficult to find right now. Now on the 35-week on the S&P, a little bit better shape than the NASDAQ, however, still below that 35-week, but the 35-week continues to kind of stay in somewhat of an uptrend. Now this is an indicator we're continuing to keep an eye on. This is where we're comparing the S&P 500 to the 30-year Treasury bond. And you can see that the ratio is hitting new highs, actually in a very strong uptrend. Stocks are doing better than bonds. Interest rates are going up. However, and we've noticed over the years that the ratio and the actual S&P 500 really they pretty much stay together. So the fact that this is making a new high, the S&P continues to kind of struggle, but it could be a leading indicator. Then we have the aggression index. You can see here resumption of the downtrend. We're comparing a ratio here of the NASDAQ to consumer staples. We're comparing technology to things like toothpaste and toilet paper, etc. So it continues to stay in a downtrend, which is not a positive. On our three economic indicators, you can see that interest rates are continuing to stay in an uptrend. The 10-year Treasury is around 2.7. Oil prices continue to be volatile, but actually somewhat in a downtrend. Financial stocks continuing to struggle. I guess being that the market is worried about an economic slowdown, it is really not helping the financial stocks. New lows continue to stay elevated, higher than we would like. Again, you just need to be very selective in here. So back to fear and greed. Okay, we know that everybody's pessimistic. Now this is where you really see markets tend to bottom is when everybody gets this pessimistic. So the reality is that there's something out there called relative strength, where you're looking for stocks that are holding up very well in a very negative environment. This is where you find the next big thing, actually. Volatility Index kind of popped up a little bit. We continue to stay below 30, which is a good sign. However, we have seen an uptick in the volatility. The trend strength really has deteriorated. We're back in zero. We were up as much as over 50%. Actually, things were looking pretty good there. But then again, we had that failed breakout. On the S&P 500, we continue to stay at around 38% on trend strength. Like to get that back above 50%. Now, energy, you just cannot ignore energy. This is a 20-year graph. This goes back 20 years where we're looking at the XLE, which is the energy stocks, oil and gas primarily. But one thing about energy, it's more than just oil and gas. There's a lot going on technologically speaking, especially in the area of nuclear energy. So you can see here the energy stocks have broken out to basically an all-time new high. We got up to this high here back in 14, then we deteriorated, came down during the pandemic. However, you cannot ignore this graph. Also, as we talk about how's the market discounting recession, well, these are the healthcare stocks. Now, one thing we know about healthcare, especially pharmaceuticals, it's like a consumer staple. People have got to have it. But the most important thing about healthcare is that even in inflationary environments, they can raise their prices and not see demand deteriorate. Transportation stocks, you can see here, definitely in a downtrend. Got a little bit of a bounce in here recently, and then these are the financials. So you got the transports and the financials in a downtrend, but then you got the conservative healthcare stocks in an uptrend. Market seems to be worried about economic slowdown. Interest rates really causing the bond market to have a very difficult time here. This is the TLT, which is the 20-year Treasury bond, which is a fund. But you can see here, definite downtrend. Interest rates are really impacting the bond market. Now, in the top five, we just kind of continue to see things like CF Industries, which is fertilizers, continues to be companies where, again, you have to think about it. Fertilizer is critical to the production of food. Well, we've got to have food, so basically these stocks are holding up quite well. Here's a medical stock called Lantheus Medical Supplies. They're involved in digital imaging. They provide supplies to hospitals and so forth for digital imaging. This stock is really looking quite constructive. It's in a nice uptrend, holding that 10-day moving average. We like the stock. Occidental Petroleum, again, the energy stocks, as you can see, now Occidental is more into refining as well. However, just moving sideways, but continuing to hold up, which is kind of unique. Here's a company that just got bought out yesterday, a company called Sierra Oncology, getting bought out by Glaxo. You can see the gap up here. I mean, the stock was up 38, 39% yesterday on the buyout news. This is Alpha Metallurgical, which is a coal producer, a coal mines, basically, breaking out. Again, energy. Is there a technology out there for clean coal? That's really a big question that I would have. But anyway, as we would say, it looks like energy, consumer staples, pharmaceuticals, defense contractors are all holding up real well. So if you have any questions, please give me a call. Thank you very much.